All right, welcome to Accounting or BA 211, Accounting, Principles of Financial Accounting or whatever it's called. This is about financial accounting, and so hopefully you've gotten the book, the book by John J. Wild. So I would suggest you read each chapter first, and then maybe after you do that, listen to the lecture I've prepared for each chapter, or you could reverse those if you want, and then work through the problems on Connect, and then do the quiz for each chapter that's on Connect. If you do that, you should be okay. All right, so let's start with chapter 1. Okay, so here are your learning objectives. You can read those on your own. All right, so what's so important about accounting? A lot of talk about accounting in business. What are the numbers? What do the numbers say? You'll hear that quite a bit. And so the importance of accounting is because that's the way we talk in business. We talk about things in relation to how well a company is doing. So you have to know accounting concepts. You have to know. There's nothing more embarrassing than a business person who doesn't understand basic accounting concepts, and you really show your ignorance when you don't know this stuff. So even if you're not an accounting major, please learn the basics of accounting, because it will make you much more of an astute business person, and you won't look like a fool to your peers and possibly your superiors. They want to promote competent people, and if you don't know accounting, they're probably not going to think you're very competent. So let's look at the definition of accounting. Defined as an information and measurement system. Okay, so it provides information and it measures. It identifies, records, and communicates information about an organization's business activities. So you've got three things going on there. It identifies, it records, and then it communicates information about the organization's business activities. And so if you look here, first thing you have to do is identify those activities that have some current economic change in the company. And then once you identify those, you record them. You keep a chronological log of transactions. And then every once in a while, you're going to communicate your results by preparing, analyzing, and interpreting, eventually, reports such as financial statements, which we'll talk about here in a minute. Now, who are the users, and what are the uses of accounting? What are the opportunities in accounting? I can say that they're pretty darn good, thank you. So who are the users? Well, you can put them into two groups, pretty large, diverse groups. But you have your external users, and then you have your internal users. Now, primarily, external users are the constituency for which we are preparing financial statements. And so the financial accounting is more for providing information, these financial statements, to external users. External users are users outside of the company, but have some connection to the company, such as potential lenders, potential creditors. Some, if you're considering selling to a particular company, shareholders certainly are. Many of them are outsiders. They're not intimately involved with the company in their day-to-day operations. Government entities, certainly. Consumer groups, external auditors that we'll talk about somewhere along the line, and of course customers. Now, internal users are individuals who are inside the company. They work the day-to-day operations of the company. Examples of those are, of course, officers, managers, internal auditors, sales, production, you name it. Now, these people are primarily interested in information that's going to help them do their job better, whatever that job might be. And so they are not primarily interested in these financial statements that the external users use. They're interested in more custom type of reports that help them with their job. And so there's a different kind of accounting that handles internal users, and that's called managerial accounting. We're not going to be dealing with managerial accounting in this particular course. That is BA 213 that gets into managerial accounting. As I may have mentioned, accounting is called the language of business because organizations set up their accounting system to communicate data to help people make better decisions. Now, this accounting information system handles both financial statements for external users as well as the managerial accounting reports that internal users need. There are many opportunities in accounting. I won't say that they're endless, but many opportunities abound if you are interested in a career in something accounting or accounting related. Even if you're interested in something in finance, having a strong accounting background will get you there. So the book breaks these down into 4 different categories. If you're interested in financial accounting, you could work inside of a company and prepare financial accounting documents. You could be an auditor, an external auditor, and there you would help in rendering opinions on the correctness of a company's financial statements. You could go into consulting, you could go into business planning, you could work for the FBI as a criminal investigator with your financial accounting knowledge. If you're interested in managerial accounting, you'll work for a company and handle things such as cost accounting matters, budgeting, internal auditing. You could become the controller of an organization, could be a treasurer. You could be a financial planner or a strategist. If you get into taxation, usually that's part of public accounting. Public accounting, they do a lot of different things. A big part of what they do is they're external auditors for companies, and they come in and audit financial statements and render opinions on those. But CPA firms also do a lot of taxation services as well. So there's what they call compliance work, which is a fancy word of saying tax preparation, tax planning, tax investigations, tax consulting, litigation support, and estate planning. And then there are this other group called accounting related opportunities. And so you know, if you're a lender for a bank, you really need to know your accounting, because you're going to be looking at a lot of financial statements. You need to know what you're looking at. Consultant, traders, underwriters, appraisers, FBI investigators, market analysts, forensic accounting. That's a very interesting one. If you're an entrepreneur or planning to be, you need to know your accounting. Even if you're not the accountant, you have a business, you need to know accounting concepts. Even if you hire an accountant, you need to know what they're talking about. So here it says accounting information is in all aspects of our life. When you think about it, we're keeping score one way or the other, and we do that with accounting information. So I'll let you look at this. Identify the following users of accounting information as either external or internal. If you're a regulator, you're external. You're a CEO, you're internal. Shareholder, usually external, but if you're like, you know, a CEO who's also a shareholder, you'd be internal too. Controllers, internal. Executive employees, internal. External auditor, external. Production manager, internal. And non-executive employee is internal as well. Why are ethics crucial to accounting? Well, would you hire an unethical accountant? I don't think so. Why would you not want your accountant to be unethical? Well, not only are they going to probably steal from you somehow, but you want the numbers to be correct. And ethics ties into the correctness of the financial information. And of course, there's a separate course for ethics, business ethics, I believe it's called. And it seems like every course has an ethical portion to it, if not kind of an ongoing dialogue concerning ethics. So, I don't want to spend a lot of time on this because ethics are important in all areas of business, but it makes perfect sense that, well, two things. Accountants are going to have some ethical quandaries come up. They're going to have to make a decision concerning something they perceive as being possibly unethical if they do it. And so if they go down one way, what they do is unethical, but if they go down another way, it's ethical. And so, you always want to err on the side of ethical. Make good ethical decisions. And again, the book talks about if you're an accounting major, you'll get into this more, this fraud triangle, which asserts that three factors must exist for a person to commit fraud: opportunity, pressure, and rationalization. So, what's opportunity? Well, through some hole in the system, some loophole, an employee is able to act unethically to defraud the company. Pressure. A person must feel pressure or have incentive to commit fraud. They're underpaid, and so they're committing fraud to, pay their bills. They have a gambling problem. They have a drinking problem. They have a drug problem. Maybe all of the above. Rationalization. The person justifies the fraud and fails to see its criminal nature. They're not paying me enough, so I deserve a raise. So I'm, and they make plenty of money. As the book points out, it's best to stop fraud before it happens. So prevention is a big part of what we do here. And we do so through what's called internal controls. We put in place internal controls that will prevent fraud, because it's easier to prevent it before it ever happens than to detect it after it happens. But you also want to have internal controls in there that would not only prevent it, but it can happen even if you have the most fail-safe internal controls. Mainly because people collude to defraud sometimes. But you also want internal controls that detect it as well. And so internal controls are procedures to set up and protect the company's property and equipment, ensure reliable accounting, promote efficiency, and encourage adherence to policies. Some examples are: we want to segregate duties among various employees. You don't want to have the same employees doing too many jobs, because certain jobs just, if they're combined in one person, could be subject to fraud. And as a part of the fraud, they may try to cover it up by changing the accounting records. So that helps, these internal controls help in ensuring, not only that the property and equipment of the company is protected, but also by protecting them and ensuring either no or very little fraud, it ensures reliable accounting. It promotes efficiency and encourages adherences to these policies and procedures that are put in place. Now, you may have heard that there's been several large corporate scandals over the last 15, 20 years. Probably the most famous one, if you're old enough to remember, but even if you're not, you may have heard about it, is the Enron scandal. WorldCom is another one. So there was a lot of them that happened around the late 90s, early 2000s. There was more that happened around the real estate bust of 2008. So, Congress, U.S. Congress, when these things happen, when businesses fail and it's found that fraud was involved, Congress gets lots of correspondence, lots of calls for them to act. And so what do? Well, they create a new law, or two, or three, or 10. So one of those laws that they passed to try to prevent corporate scandals like this, corporate fraud, is the Sarbanes-Oxley law, otherwise known as SOX. And mainly, SOX refers to publicly held companies, meaning companies who sell their stock on a public stock exchange. So, if it's a private company, SOX does not refer to them, and it doesn't affect them in any way. But certainly public companies, SOX does affect. And so it requires that these public companies apply both accounting oversight and stringent internal controls. And so what's happened is, used to be that if you were a public company, external auditors had to come in and every year issue an opinion on the fairness or correctness of your financial statements. Well, SOX certainly requires that. That was already required, but it also puts a big focus on a company's internal controls, and it mandates that companies have and monitor internal controls so that they're adequate to protect companies' assets and financial reporting. And so when the external auditors do an audit of a public company these days, they're actually doing two audits. One is your standard financial statement audit and rendering an opinion on the fairness of them. But they also do an audit of the company's internal controls and report on whether or not they believe that the company's internal controls are adequate. And on top of that, company's management is responsible for reporting on internal controls in their financial statements and indicating whether or not they believe their internal controls are adequate also. So anyway, whether or not SOX has really done anything to prevent fraud or company failures, not really sure, but you know, this is what happens when disasters like Enron or WorldCom occurs. Congress steps in and tries to pass a law that at least shows that they're trying to curb this type of activity. There's also the Dodd-Frank Wall Street Reform and Consumer Protection Act, which is a mouthful. I'm not too familiar with it, but I'll just read this. It says it was intended to promote accountability and transparency in the financial system, to put an end to the notion of too big to fail. I think that's referring to mainly banks and insurance companies. Protect the taxpayer by ending bailouts, and protect consumers from abusive financial services. So this came about in 2010 after all the meltdown of real estate and bailing out all these banks and insurance companies. All right, so let's talk about generally accepted accounting principles and what they mean. And so understand that we have to have some rules. You know, every game has to have rules, right? And while this is not a game, everybody must play by, it's kind of a game. I mean, we keep score, right? It's called financial statements. But everybody has to play by the same rules in order to, I mean, think about this. If you're a potential investor and you're looking at several companies that you want to invest in, one of the things you would do is you would get their financial statements and look at them and determine which one is a better investment. Well, what if we didn't have any rules? What if we just, you know, anything goes as far as accounting is concerned? Well, you know, basically, you could just say, well, if you're the company, well, you know, what do you want the numbers to be? Well, that wouldn't be good. How could you rely on the numbers if you're an investor? So, in order to create some certainty in the accounting records, we have these rules. These rules are called Generally Accepted Accounting Principles, otherwise known as GAAP. And so GAAP aims to make the information relevant, reliable, and comparable. Very important. Just so you know the structure of, well, who sets GAAP. U.S., well, understand that GAAP is strictly U.S., United States rules. There are different rules in other countries. Many countries have adopted what are called International Financial Reporting Standards, IFRS. And there, the body that promulgates these rules is called the International Accounting Standards Board, otherwise known as IASB. Well, as far as GAAP is concerned, the SEC, Securities Exchange Commission, was deemed by Congress the body that would establish GAAP principles, but they passed it off to another group called the Financial Accounting Standards Board, otherwise known as FASB. So FASB promulgates GAAP, but the SEC has a lot of sway in what becomes GAAP. There's many similarities between the international standards and GAAP, but there are some big differences, and they've tried to get together and converge the two as much as possible, but there still is quite a bit of difference between the two. Now, FASB created this conceptual framework, and they did so without reference to GAAP. This was really kind of an aspirational thing, this framework. And so this framework consists of objectives, and the objective of a good system of accounting, financial accounting, is to provide information that's useful to investors, creditors, and others who rely on this information. The conceptual framework is broken also into qualitative characteristics, just what we talked about, to require information that's relevant, reliable, and comparable. It has several elements, which if you get into intermediate accounting, you'll learn. And then it addresses both the recognition and measurement of certain elements in the financial statements. So if you're an accounting major, you'll learn more about that in the future. You have several principles and assumptions, as well as some limitations that make up GAAP. And so you have general principles and you have specific principles. And what you have here is in this little drawing is the general principles. And then below it you have these assumptions, and then below that you have these limitations or constraints, if you will. The principles involved here are principles involving measurement, full disclosure, revenue recognition, and expense recognition. The measurement principle is also called the cost principle. And so the cost principle just says that we record the value of an asset or a liability at its cost. Why do we do that? Well, it's objective. We know what something costs. We have record of it. Versus measuring, what if we measured an asset at its fair market value? Well, we do some of that as well in accounting, something you'll find out in later accounting courses especially. But many things are still measured using the cost principle. Then you have the revenue recognition principle. You recognize revenue here, and one thing you'll learn about GAAP accounting is it's not cash accounting. You don't recognize revenue when you receive cash. We use the accrual method of accounting, and so under the accrual, ACCRUAL method of accounting, you recognize revenue when it's earned. Well, when is it earned? Well, usually when you provide a good or service, it's earned. And at that point, you would recognize the revenue based upon what you believe you will receive. Note here, the proceeds do not have to be in cash to recognize revenue. So you don't have to be paid in cash. You can be paid in other services. You can be paid in property. The matching principle, otherwise known as the expense recognition principle, just means just like you have to recognize revenue when you earn it, here you recognize an expense when you incur it, not when you pay it. And last but not least, you have the full disclosure principle, which just means that, and you'll, if you look at financial statements enough, you'll know that, well, even a few, you would know that a big part of a financial statement is not just the four financial statements that are part of it. A big part of this is the notes to the financial statements and such things as management discussion and analysis that's a part of the notes. And so that helps users, these external users, to understand what the company is doing better. Your accounting assumptions, the going concern assumption. The assumption is that the company will continue to be in business. It may not, but at least the assumption is that it will when you're preparing these financial statements, because otherwise, if you had an assumption that the company wasn't going to stay in business, you would not measure assets at their cost. You'd probably measure it at fireside value, or fire sale value. I mean, not fireside. Monetary unit assumption. Everything's valued in monetary units, which for U.S. GAAP is the dollar. Business entity assumption just simply means that it's assumed that the business is separate from its owners. The time period assumption, I mean, a business continues on endlessly until it stops, but you know, in order to measure our performance, we break the performance up into time periods, monthly, quarterly, yearly, to find out how we're doing. Here's some pros and cons of you know, corporation versus partnership and proprietorship. Proprietorship is one owner. Partnership is two or more owners. The good thing about proprietorships and partnerships versus what they call a C corporation is a C corporation is considered separate from its owner, whereas proprietors and partnerships are not. So the corporation is taxed, whereas the proprietorship and the partnership are not taxed separate from the owner, or owners if you're a partnership. Limited liability, you don't have any if you're a proprietor or a partner in a partnership. Shareholders in a corporation do have limited liability. And that includes legal liability. All right. Accounting constraints, two that they mention are materiality. You want to disclose things that are material. Material being if it's going to change a decision, how a decision maker makes a decision, then you need to include it as part of the full disclosure principle. But if something's not material, meaning it's so inconsequential that it doesn't change how an external user would make their decision, then you don't include it. You don't disclose it. And that kind of ties into the cost-benefit rule. Only information with benefits of disclosure that are greater than their cost needs to be disclosed. So you look at the cost of things, and if it's going to cost more than it's worth in benefits received, you don't do it. And I'll let you work this on your own. All right. So here we want to define and interpret the accounting equation. And so we're going to take a little break, and we'll deal with that here in a couple of minutes.